Welcome back, and joining me for a look at what's played itself out on the market scene today is Towell from Sasfin Securities. Rob, let's start off with the South African Reserve Bank that decided to cut interest rates for a second time in this cutting cycle. Again, another 25 basis point cut. But looking at the inflation figure that we got yesterday with an aggressive cooling down there, were there no conversations of maybe a more aggressive move from the SARB today?
So they said that there was no one that even spoke about a 0.5% point, 0.5% cut. So they've just kept, relatively restrictive at 25 basis points. Our market could easily do with 0.5%, and our inflation is relatively benign at the moment. However, it is largely due to the oil price, and that oil price is out of our control. So if that oil price really does spike, then our inflation picks up straight away. So it is relatively benign and a really good print from our inflation side. I think it's a good opportunity to cut rates while they can during this cycle. However, they cut them at 25 basis points and are going to be showing a little bit of caution. But I think our market, and you could see from the retailers today, they were up by 3.5% across the board. Really do need that interest rate cut and responded well to it. But I think our market could have easily done with 0.5%.
Yeah, indeed. Well, let's go into those retailers that will be impacted by the interest rate cycle. Let's start off with Mr. Price. They came out with interim results. They had revenue growing more than 5%, headline earnings per share there showing an improvement of more than 7%. We did see that share surging over 7%. Warranted?
Well, I think that the numbers as a whole were mixed. They were okay numbers. Fair enough, starting to take market share, but actually their guidance and the start of the next half of the year has been very, very strong. So I think that's what the market liked. They saw really good growth since the market closed at the end of September. So, the October's been very strong, and the beginning of November's been very strong as well. And they spent quite a lot on stock as well to make sure that there's no bottlenecks for Christmas stock. So they've spent a lot there, and they're starting to see quite very good, strong growth going forward. So I think it was more not just the numbers, but what they said going forward. And the first 2 weeks of the next half of the year have been very strong in the market like that. I mean, it must be nearly 100% over a year and a bit, Mr. Price. And I think it's at an all-time high where it closed today. So, it's starting to get a little bit expensive. But if that growth does materialize beyond Christmas and into, the new year as well, then it'll be justified.
Well, another retailer that's also been stocking up on inventory is Lewis. They also released their interim results today. We did have a double-digit increases in their financial metrics, all the way down to the bottom line, where we saw that headline earnings per share figure climbing more than 49%. But it was quite interesting to see the market reaction, because initially that stock climbed about 4%, but then by the end of the day, it's down around about 5%. I mean, how did investors digest these numbers?
Well, they're very good numbers again from Lewis. So all their metrics were really good across the board. And all their sectors, they didn't really have a poor sector within those earnings. I think what happens with Lewis is that it's very thinly traded, and it's difficult to buy and to get out of the stock. And on a day like this, when there's a really good set of numbers, some people do take the opportunity to sell into the volume. And therefore, sometimes you get a move too far up or too far down, which actually isn't, exactly where the numbers suggest. So I think it's an opportunity for the bigger players that have to move a lot of stock to exit on days like this. But a very good set of numbers. Lewis as well, one of the best performing stocks this year on our exchange. Well managed, their debt's coming down, and the interest rate coming down really helps them as well.
Yeah, all right. Rob, as we're talking about, I guess, consumer-facing stocks, there's also Southern Sun. They also released their interim results today, talking about a 39% growth in adjusted headline earnings per share. Room rates are up, occupancies are up. They do talk about some things that impacted the numbers. What did you make of those figures?
A fair set of numbers. I think occupancy over the period is about 58%, which is up about 2.9%, which is fair. They also said that, however, in October, occupancy went up to 68%. And from 68 and 70%, you really start making a lot of money. So if those occupancies carry on through and stay at that heightened level, you start to get into 70% and above, then the hotels make a lot of money, and there's lots of gearing that they can make from those levels. So 68% is a good number. Let's see if it holds as well through the holiday period and into next year. But you are seeing, they mentioned that the visa restrictions are a little bit better. You're starting to see more flow from tourists from China and India. So that really plays into their model and their business model. But we'll just have to see, if we get these changes on the visa side, really help tourism in general in South Africa.
Quickly, Rob, before we get to your stock pick, we also have Investec also coming out with its interim results, talking about a holding. It also kept its growth momentum going there. Not much reaction from the market, but I guess these numbers were expected.
Yeah, these numbers were expected on a return of equity. They're one of the lower numbers, about 13.9% compared to some of the other banks that are at 17%. So they're a little bit lower on the return of equity side, but they have been changing their business over the last few years, and it's a much cleaner business. They had a bit of a tough time in the UK, and their debtor book in the UK took a little bit of a hit.
Yeah.
But going forward, their guidance was relatively firm. They've also sold Assupol, so they've got a couple of billion in there. They didn't give any indication what they're going to do with those funds, but probably put it into the balance sheet and start to maybe lend out again with those extra funds. The PE is undemanding at about 7.8%. So it has got opportunity to move up. And so it's not expensive at this, on its earnings, but probably not one of the stronger banks on a return of equity side. But I still think a buy at these levels, and you can probably look to 15% upside from these levels.
All right. Well, talking about upside, let's get to your stock pick for today.
I'm going to go for Boxer. Obviously, it hasn't listed just yet. It's going to be an IPO. If you can't get in now, I would still suggest that you buy on the open and into the next few weeks. Also, undemand in PE between 14 and 15 PE, where it's going to list, where you get a ShopRite at about 23, 24 in Pick and Pay and Spar, also close to 20 PE. So it's not a demanding multiple. The market likes the business, and it's got potential to grow into interest rate cutting environment, and it's moving into the right sector. So I think if you can't get in the IPO, I think you should just buy it next week when it lists as well. And I think you'll do well over the next 18 months.
All right. Well, thank you so much for your time and for your analysis today, Rob. That was Rob Towell from Sasfin Securities.